Welcome back, friends. Today we are talking about chapter 5 of the book we've been going through, which is The Power of Zero. And so chapter 5 is actually one of my favorite chapters because it's talking about life insurance. So he refers to it as the LIRP, or the Life Insurance Retirement Plan. So just as a quick recap, the last couple days we were talking about the different buckets for your retirement funds. You have your taxable bucket, which is your CDs, money market, savings accounts. The second bucket is your tax deferred income, which is your IRAs. And so far in the third bucket, which is your tax-free bucket, yesterday we talked about, or a couple days ago, we talked about the Roth IRA. So today with the LIRP, the Life Insurance Retirement Plan, we're talking about a couple different things about it. One, it is truly tax-free with his two requirements, which is one, it doesn't get taxed on the federal or state level. And then secondly, that the income or growth with life insurance doesn't count towards the taxation calculation for your Social Security. So it really is tax-free. So life insurance, a lot of times when people think traditionally about life insurance, they want the most amount of death benefit as opposed to the lowest death benefit. So we usually look at, okay, how much life insurance can I get for the cheapest amount, basically. So what he's talking about here is a different way to use life insurance. So with these plans, what the goal is to have the lowest amount of death benefit and then put the rest of the cash or the premium that you're putting towards the life insurance into a cash growing account. So part of the premium would go to your death benefit and the rest would just get stashed away tax-free. So just remember there are limits on how much you can put in as far as cash growth. So then that way it meets the IRS limitations. So that is really important. Okay, so then he talks about the benefits of it. So again, I have my notes here so I don't miss anything. So first of all, the biggest benefit of the life insurance retirement plan is there is no contribution limits. So with the Roth IRA, the IRS does impose how much you can put towards this account every year. Whereas with life insurance, there is no maximum contribution. So you can put in as much as it's allowed to not flip it into a what we call a MEC for IRS purposes. So you can put as much as you want as long as it doesn't overtake the death benefit. Excuse me. So you want to buy as little as you can. The second one is there's no income limit. So that means you can start one of these types of accounts regardless of your age. You don't have to be making any earned income like a Roth, so you can get one for your kids, and you can also contribute to it when you're pulling Social Security in retirement. The other bigger claim to this, which I didn't know, and I think it's a great fact, is 85%, at least at the time that the book was written, of the Fortune 500 CEOs are using this as their primary source of retirement because they're making too much money to be able to contribute to a Roth. So if they're doing it, we should be doing it. The other thing that I thought was really interesting is that the tax laws obviously do change over time. And he does mention that there is no risk for this type of policy because in the past, Congress has tried to change the tax laws regarding your retirement accounts. So with the Roth, of course, right now, it's costing them billions of dollars of lost revenue to have this Roth savings account because they're not getting taxed on the growth. So in the future, they could be changing laws so then that way any accounts that are already in existence for your Roth would be fine, but you can't contribute more, potentially. But for the life insurance, there is a grandfather clause that I also didn't know about, is the fact that if they do change any tax laws, all your life insurance policies would stay the same because they'd be grandfathered in, and you would be able to continue to put money towards it. So there wouldn't be any tax impact on contributions, which is pretty cool. The other thing that he mentioned as benefits is there's usually 3 different funding strategies for life insurance. So the first one is the insurance company's portfolio. So they would dictate where the funds would go. The positive part of this is it is very stable because the insurance companies are very risk adverse. So the good news is you know that the money would be safe in these types of plans. However, the downside is they would be a very conservative growth. The second one is putting the funds into the stock market. So the pro on that would be you would get the growth, of course, more aggressively, and you could see greater gains. However, in a down market, you could lose it because it's directly tied to the market. And then the third approach is actually the one I like the most personally, is the indexed approach. So what these funds are linked to an index. So what it does is it doesn't follow the stock market directly. It just looks at the trajectory of it. So think of like the S&P 500. So then that way you get to participate in the gains. However, you're also protected against the losses. So in a lot of cases, if the market goes down, you have everything stay the same, or some of the policies would give you some small amount of growth, but it'd be better than the alternative. So usually, according to the book and just historically, these types of funds would see anywhere between 7 to 9% growth. So it is pretty stable over time, and you're able to still get the growth. Okay. As anything else, he does mention it is very important to have the balanced approach. So don't put all your eggs in one basket, but it's a good idea to invest in the different funds based on your situation, right? So then, of course, being insurance, the last benefit that he mentions is one of my favorite. So he actually says that the life insurance policies could work double duty as a long-term care. So I actually think they could potentially have 4 things that it can do for you. These types of policies can help you in 4 different ways. So you get the living benefit. So if you're not doing well and you're sick, you can actually pull for it for illness, for long-term care. You could get obviously the death benefit if you end up passing, and then you can also use the cash for retirement. So there's 4 different ways you can use this policy, which is pretty awesome. So then he talks a little bit about traditional long-term care policies. And this is a hot topic right now because everybody knows that the cost of long-term care is not going down. And I actually saw a statistic that 66% of people have major anxiety when they start thinking of long-term care cost. So what's the difference between having a life insurance policy that can double as a long-term care? So the traditional long-term care policies, if you were to buy it now as you're looking close to retirement, the cost of them will be astronomical and wouldn't make financial sense. The other thing is that a lot of times with the folks like my parents who have had their policy for years and years and years, now the cost is starting to increase, the premium, because people are starting to use it, 1. And 2, a lot of these policies have a wait period. So going back to my parents, they have a 6-month wait. So meaning they have to fund the first 6 months of their long-term care before their policy will actually kick in. And I've actually been hearing from a lot of clients that their parents aren't even making it past those couple of months. So now they put money into a policy that they haven't ever used or won't be able to use. So that's kind of the pro of a life insurance policy, is that you're going to be able to use it one way or not, whether you're living or after you died. At least your kids or whoever you name as your beneficiaries will be able to get the benefit of it. The other thing he talks about long-term care, and I know it's not always an easy topic, but what he brought up is really true financially, is that a lot of times financially it's better for a loved one to actually die than have them sit in long-term care for 5 years, because you're going to drain all of the accounts that you work so hard and then have to potentially go into Medicaid. So he had this scenario where he was talking about the husband had an IRA of 500,000. And so the wife didn't work, so she has no retirement. So what happens if he ends up in long-term care? In this situation, he had a stroke, so he wasn't able to take care of himself or drive himself around, so he had to go to a long-term care. So in order for Medicare and Medicaid to kick in, he has to use up pretty much the majority of those assets before Medicare and Medicaid would kick in, and then the wife gets nothing. So she's been planning for retirement all these years using that $500,000, but after they use all those assets, and I ran the calculation, it's only like 5 years that 500,000 would last potentially, then what's going to happen to her? So that's why it's really important to have these types of plans. So then that way you don't have to rely on Medicaid or losing all your assets for a long-term care situation. Okay, so what else? Okay, the true cost. Okay, so he talks a little bit about the cost of a 401k versus the life insurance. And he says at the end of the day, they're almost the same, about 1.5% for either one. So a lot of folks don't realize in their 401ks, they are paying fees on it. So the fee, the 1.5%, goes to a lot of different things like the fund managers and record keepers and financial advisors. So although they're thinking, hey, I'm getting 8.7% of growth, it really is, or 8.5, it's only 7% once you factor in the fees. And then he looks at the life insurance side, and he said over time, most of the life insurance have the same fees. The question is, what do you get for it? You know, so with the 401ks, remember, you could get that big exposure in the future, whereas with the life insurance, you can use it 4 different ways, which is pretty cool. All right, so then why haven't we heard of these LIRPs? The other thing is, another hot term right now is the TFRAs, the tax-free retirement accounts. Most people don't know about this because most of us are not in the top tax bracket of wealthy individuals. So those are the folks that are actually utilizing these types of plans. As he mentioned previously, and he did repeat it, and I think it's worth repeating again, that 85% of the Fortune 500 CEOs are using this as their primary source of retirement income. And by the way, so are Congress members. So if they're doing it, it must be working. So just as a quick recap of everything we talked about through the last couple days and today, what's the ideal balance to get to that 0% tax bracket in retirement? So in the first bucket, the taxable bucket, you want to have about 6 months of income as your emergency fund. Anything more than that, then you're paying too much tax on it now. Secondly, in the tax deferred bucket, you want to be able to contribute enough to your IRAs, your 401ks, anything like that, to be able to, once you get to the required RMD age, to be able to match the standard deduction. Because anything more than that, then you're going to be taxed more on that higher tax bracket. And then the rest of everything goes into your tax-free account. And how do we divide those up? So in your Roth IRAs, put in everything you can to get up to that limit, the IRS limit for the year. And then the rest of it would go into your tax-free retirement planning account. Hope that makes sense. Look forward to hearing from you. If you have any questions, you can always reach out. Can't wait to see what else he has in store for us.